The financial crisis in the USA: causes, impact, and lessons. The financial crisis of 2007 to 2008, often referred to as the Global Financial Crisis (GFC), was one of the most severe economic downturns in modern history. Originating in the United States, it exposed systemic vulnerabilities in the financial sector, leading to global repercussions. This essay explores the causes, impact, and lessons of the crisis, emphasizing its profound implications on economies worldwide. Causes of the financial crisis. 1. The housing bubble. At the heart of the crisis was a housing bubble fueled by rising home prices and speculative investments. From the late 1990s to the mid-2000s, home prices in the U.S. increased rapidly. This surge was driven by easy access to credit, low interest rates, and financial innovations such as mortgage-backed securities (MBS). 2. Subprime mortgages. Lenders began offering subprime mortgages to borrowers with poor credit histories, often without verifying their ability to repay. These risky loans were bundled into MBS and sold to investors, spreading the risk throughout the financial system. 3. Financial deregulation. Decades of financial deregulation allowed banks and financial institutions to take on excessive risks. The repeal of the Glass-Steagall Act in 1999, for example, blurred the lines between commercial and investment bank, enabling risky investments. 4. Credit default swaps and derivatives. The rise of complex financial instruments like credit default swaps (CDS) created a web of interdependencies in the financial system. These instruments, often poorly understood, magnified the risk of systemic collapse when defaults began to rise. 5. Failure of regulatory oversight. Regulatory agencies failed to anticipate and prevent the buildup of systemic risks. The belief in market self-regulation contributed to unchecked speculative behavior. Timeline of the crisis: early warning signs 2007. In 2007, mortgage delinquencies began to rise as borrowers, especially in the subprime category, defaulted on their loans. This led to the collapse of major subprime lenders. Lehman Brothers bankruptcy 2008. The crisis reached its peak in September 2008 with the bankruptcy of Lehman Brothers, a major investment bank. This event triggered a panic in global financial markets. Global recession 2008 to 2009. The financial turmoil led to a severe global economic downturn, with GDP contraction, rising unemployment, and plummeting consumer confidence. Impact of the financial crisis. 1. Economic recession. The U.S. economy contracted significantly, with GDP declining by over 4% during the crisis. Millions of Americans lost their jobs, and the unemployment rate peaked at 10% in October 2009. 2. Collapse of financial institutions. Numerous financial institutions faced insolvency or bankruptcy. Notable examples included Bear Stearns and AIG, which required government bailouts to prevent a complete collapse of the financial system. 3. Housing market crash. The housing market collapsed as home prices plummeted. Many homeowners found themselves underwater, owing more on their mortgages than their homes were worth, leading to widespread foreclosures. 4. Global ripple effects. The crisis had far-reaching consequences, triggering recessions in Europe, Asia, and beyond. Countries like Greece faced sovereign debt crises, and international trade declined sharply. 5. Government intervention. The U.S. government implemented massive stimulus packages, including the Troubled Asset Relief Program (TARP), which injected $700 billion into failing banks. The Federal Reserve slashed interest rates and introduced quantitative easing to stabilize the economy. Lessons learned. 1. The need for stronger regulation. The crisis underscored the importance of robust financial regulation. Reforms like the Dodd-Frank Act 2010 to address systemic risks by increasing oversight of banks and financial markets. 2. The dangers of speculation. Excessive speculation in housing and derivatives markets demonstrated the need for greater caution in financial activities. 3. Systemic importance of financial institutions. The concept of too big to fail highlighted the interconnectedness of large financial institutions and the need for mechanisms to handle their potential failures. 4. Global coordination. The crisis emphasized the need for international cooperation in managing economic and financial stability. Organizations like the G20 played a critical role in coordinating responses. Conclusion. The financial crisis of 2007 to 2008 was a stark reminder of the fragility of the global financial system. While significant reforms have been implemented to prevent a recurrence, challenges remain in ensuring long-term economic stability. The crisis serves as a cautionary tale about the consequences of unchecked greed, inadequate oversight, and systemic vulnerabilities. As the world moves forward, the lessons from this period remain crucial for building a more resilient and equitable financial system.